My name's Michael Baragwanath. I'm the Managing Director at Clime. That's a terrible little cutout. I'm actually in 254 North Terrace here in Adelaide when they took that photo, but it's a very dark background, so I've been asked to get another photo. Thank you very much for coming. I'll speak for a few minutes around a few areas of my expertise, and then Garth will do a quick intro into John, and then we've got the main event. So I'm not going to make him stand there without talking for very long, but just a few little things that we found interesting that's probably more to my background that I'll talk to. I'm sorry to those that were at dinner last night, you're going to get a truncated version, not as much gossip as we sort of discussed last night with respect to some South Australian iron business, but we'll just talk more about other areas. As Managing Director, my role is to sit across our funds management business, our what's called automated portfolios business, and our new direct business. And direct means transacting directly with opportunities in the market, whether that's assisting in merger acquisitions, like was it MyState and Auswide, so we assisted slightly with that transaction, real property transactions and direct lending, I should say. And I'm going to speak for a few minutes around direct lending because there's actually quite a lot of issues coming up in the media around that, and I'm going to talk about why that market exists, why there are good opportunities there, and why you've got to be really careful with it because it's quite appealing until something goes wrong. The other thing I'll quickly do is just introduce the team a little bit. So we've got George in the background. So if you see us do really well in social media, it's because he's fantastic at it. So if you see us on TikTok and you see content that we put together on TikTok. Do you know when NetBank first came out, the fastest adoption rate was amongst people over 55. The young people stayed away from it, actually. So you guys, you're all over it most of the time. So TikTok's one version, right? Twitter, X, what else we got? Instagram. We're sort of working with George to get all over that, and hot topic for another day. We've got Angela, who actually is a partner here, or a senior associate at Norman Waterhouse Lawyers. She's a migration lawyer, is her area of expertise, but also assists in our company as the co-secretary. So fantastic on compliance. If I stuff something up, she'll tell me in a meeting. Garth Curry, you've probably met before. Garth heads up our investment specialist team, so he's sort of above a financial advisor, if that makes sense, managing portfolios for high net worth clients. Adam Sferuzzi's just recently joined us. Adam lives here in Adelaide. I've known Adam for too long, but joined us from ANZ Private, and he actually heads up our international fund and our automated portfolios. So he's not a financial planner, he's very good at that, but now he runs our investment team, or one of our investment team options. Matt Rankin in Dallas, they've gone to get coffees. That's a very important job, so I'm not going to get in their way. But they're here, they'll come back and filter the coffees across the room. So private credit, something that I've been in and around for the last sort of 10, 12 years, both here in Hong Kong and Dubai and with construction projects. Why does that exist? You'll see it, and it's coming up in the media now with Metrics and a few other companies coming up and talking about the assets they're invested in and whether they've gone well or badly. The reason private credit exists, it's always existed really. They were used to be just called lawyer loans. So what used to happen was lawyers would just have high net worth clients, they'd connect the two together, they'd issue documents, and someone would get access to capital and someone would make a good return out of it. It's become sort of more commercialised in the last few years, and it's largely because off the back of the GFC, there's a set of international banking standards called Basel III, or Basel III. Go back even further, we had our own mini GFC in the 90s where two of our major banks nearly collapsed and the other two sort of had to bail them out. And we introduced APRA. So we had prudential regulators that control the capital that's available, right? We deregulated our credit institutions in the late 90s, which allowed us to bring capital in from overseas. And then after the GFC, we introduced these new rules that changed basically what the value of cash was to a bank, right? So what happened in the past was that banks would get deposits, so they'd chase you for term deposits, they'd use that money for business lending, they'd use it for home lending, they'd use it for construction financing. Basel III changed those rules and basically said that home loans are gold and everything else is third, fourth, fifth tier, basically. So the amount of cash they would need to hold in the bank to do business lending went up. And in some areas, it went up by a factor of 5, right? So what was happening, and has happened the last sort of decade, has been there's two credit markets. There's the bank credit market, where if you fit the mould, you'll get lending at very, very cheap rates. And then there's, I've just skipped that, but there's no slides. It's just me prattling on, so it's okay. And then you had the private credit market, which has grown and grown and grown. And it's grown out of necessity because all the transactions the bank used to do, they just don't, right? So that is sort of where it came from. It's essentially is global banking standards shutting that area down. And you've seen that with anyone that's been running a business. You'd have cash flow lending. Normally the bank would do that. It's now sort of Scottish specific and maybe some of the smaller banks, which has made life quite hard for businesses. And from an economic complexity perspective, our economy has become banks, housing, and BHP. That's basically it, right? So we're now less economically diverse than South Africa as a country, whereas economic diversity is as a measure for your resilience, right? So we're quite exposed to really great industries, but we're quite exposed to them, right? So that's sort of what's driven this private credit market, and why you've had banks lending 1.75% at one stage, private credit sitting around 10, and it really hasn't changed. So even though interest rates have come up, private credit's still sitting around that sort of 8 to 12% return. The problem is a lack of transparency. So the one thing I'd warn you if you look at this sort of market is you really need to know exactly where the dollars are actually going. So one of the things that's hitting the media right now is retail superannuation funds rated by rating agencies, put into platforms that are available on all the major platforms, blowing up between $600 and $1 billion worth of retail savings. And when I say blowing up, I mean, we said it's a global income fund, which means I'm going to lend my mate, who's an ex-director, $70 million to invest in Uluwatu and Lombok in Bali, with a recovery rate of about 15%. So you would never know, right? In fact, most people in our industry on our side would never know, because a rating agency said favourable and a major platform said it's good. And you'd assume that one of them at some stage would ask some questions around what the hell they're actually doing with the money. No one did. No one did. Right, so if there's one thing you take away from today, apart from all the economic messaging with John, is know where your money is and ask people, and if they don't give you answers, ask for it back. Because the trust you'd expect to have, we're not seeing in that space. But private credit can be quite good. You're essentially taking a mortgage position against real property. If it's run well, it's quite a good return normally. It's normally paid pretty regularly. If something goes wrong, you can be mean and sell the asset. You just want to make sure the people that are working this for you know what they're doing, are transparent and show you what's actually happening, and they have the capacity to deal with it if it goes wrong. Because you don't have to immediately step in and sell. You can manage people over time, you can help them out, you still get a good return. But if you don't know how to manage situations like that when they go sideways, you can end up with big legal bills and big losses. The easy answer is just avoid it and deal with shares. But these sort of things are way less volatile. So it depends on what you're sort of looking for. And the reason I've talked about that a fair bit is we've got, we do think it's actually a great area to invest in. We also think that there are a lot of opportunities where others will make missteps, and we can benefit from that, and we can help you benefit from that as well. So I just wanted to talk for a few minutes around, an area that is really topical in the media, really interesting, can be dangerous if you're not looking at it properly, but our role is to bring you solutions you can't easily do yourself. The equity side of things is about our ability to research value and deliver it, our ability to leverage John and Adam's talent in picking things, but it's also about finding transactions you can't easily do yourself. So, we can put together capital pools for large construction. We have invested, a bit in South Australia now, and I live here, so I'm going to want to do more of that. But that's the sort of things that we look to do. So, very little sort of history lesson, bit of information, pretty topical. That's probably enough from me.
Right, good afternoon. Thank you very much for coming, and it's so nice to see so many familiar faces, because we've been coming here for a few times now. And awesome premises where we can see some beautiful view and getting to know your beautiful environment here. So just wanted to say thank you. From us, we're running an investment team together with Dallas and Matt Renkin, where we're looking after you in Adelaide as your total portfolios. So we're looking from the fixed income component through to the direct equity components, to the international component, the property components of your portfolio. And what we're finding clients are now looking to, with the uncertainties of Trump, which John would expand on, is helping you and assisting you with a more balanced portfolio and making sure we limit the risks as best as we can, but also give you the best returns that we can, including income, and we cover that, what you need in your, a lot of your super funds, making sure we generate the revenue that you need. So trying to make it simpler and easier, but what we're also doing that is we also have to sometimes go a little longer term to make sure it's balanced and not looking at the very short term scenarios and swings that we're seeing currently. There's just huge volatility out there, which John will cover. So I just thought I'd cover just one or 2 points, and that is, as Michael addressed, Clime has changed quite a bit recently, and we've got a lot more focus with change in management on the, Stephen Lampert has joined us recently on the direct equity portfolio at Clime, and he's running a direct equity portfolio. But myself, Dallas, and Matt, I just put it up there. It's also on the brochure that I handed out to you, these brochures that I gave you. One is to get John's latest view and our latest quick bites that we put out on some research and get into the Clime website. And a second, of course, is to see a clearer vision of the future and, glasses cover that you can see in a clearer vision going forward. We are going to be around after the presentation, and if there's any questions that you want, I've been doing this for more than 35 years and managing people's ultra high net worth and high net worth people's portfolios and managing their expectations according to their requirements in these markets. So it's our passion to make sure that we carry out your requirements and generating what you need to generate in the markets for yourselves and to make sure you have a better lifestyle. Okay, so with no further ado, I'm going to hand over to John, who's going to talk you through this. And we are around, but we're looking forward to John's speech and discussion and his presentation to show you what's happening out there current at the moment. So over to you, John.
Look, I'll just race through the disclaimer. It's just general advice, general opinion. Some of my opinion is outrageous, and I'll deny I said it. Okay. So we had some of these charts, if you came and saw us in, I think it was November last, you wouldn't expect a lot of changes. It's really an update. So if you've seen some of the charts before, don't be dismayed. There's a lot of new ones, but obviously when you talk every 3 months, some of the charts are still relevant. In terms of what I do, for those who are here for the first time, I try to give a broad brush outline of the world, and then we delve into the charts to see if my statements are correct or can be discussed in more detail or questioned. And when we invest in the share market or the property market, even debt markets to an extent, we're investing in growth. And the first thing investors need to do, and certainly fund managers, is ensure that there is growth. If there's no growth, there's no point investing. We should all retreat to defensive investing. We're not there. And prior to Trump's election, there was no doubt that there was going to be world growth. And even today, after his election, despite what he's doing in tariffs, there's still going to be economic growth. The growth might not have been where we thought it would be. There might be a slowing in America. There might be a kick up in inflation. But if you think about it laterally, one of the things that's going to result from Trump putting pressure on Europe through NATO is they're going to have to invest in defence. And investing in defence is manufacturing. And manufacturing uses commodities and employs people. Companies grow, companies pay taxes, and you get economic activity. So a byproduct of what Trump is doing is creating activity across the world. It will also force some countries to start talking to other countries who they didn't want to talk to in terms of trade. So my point is, you read a lot of bad news, but I don't think it reflects reality. It's sort of knee-jerk. There's a lot more depth to what's going to happen. And the world's a big place, and I keep on saying it's 8.5 billion people, and it's $100 trillion of GDP. And we'll talk about numbers when we talk about the budget tonight. It's very scary for me to present pre-budget because if I say something, I could be proven wrong very quickly. I like it when I make long-term predictions and everyone forgets what I talk about. And so I'm very scared today about making statements about the budget, but I'll go there. So I know you can read, I'm not going to go in great detail. The big points are there is growth. I think the growth number for the world is still there, but it's going to be different to what we thought. I still think India is going to grow at 6% plus and China 4%-ish. Inflation's easing, although there's going to be a hiccup with American tariffs. What the extent of that hiccup we don't know because he actually hasn't settled on what the tariffs are going to be. And energy prices will fall. Okay, world energy prices will fall because it has to fall, because if you think about what Trump's trying to do, he's trying to bring inflation down in America. Why? Because if inflation comes down, the interest rates in America come down, and the massive debt which he's inherited, although he caused a bit of it last time, the massive debt has to be funded. And the first issue is interest rates, the bond yields. So if we can get inflation down, we may get the bond yields down. So what affects Australia? And I'll spend a little bit more time on Australia later. The big issue there is our engagement with China, which we challenge consistently. I don't know why we do. I think when you think laterally about it, and I said this last night in the private briefing, if you look at the negotiation between Ukraine and America, one thing that hits me when I listen to Trump talk to Walensky, or whatever his name is the Trump offer for security. He said, if you want to get Ukraine security, let me own your energy. Let me own your, I think he called them raw earths. I think he meant rare earths. I mean, let me own your rare earths. And the idea is America's invested in Ukraine, that's your best security against Russia. And I can't believe that no one's picked up on it. That's his negotiation. Let me in and Russia won't attack you. Because if they attack me, there's a war, which I'll win. And Russia will not attack America. So if I own your energy, they won't attack it. That's a pretty clear opportunity for Australia. What's our opportunity? We're worried about China. I don't know why we are, but we're worried about China invading Australia. I don't think there's a much chance of them invading Australia. They can. Maybe they'll send some boats out there one day and you'll be able to see them. Doesn't really matter. But the best way to get defence is invite their capital into our country. And if you think about the biggest risk for Australia and the Western world, it's probably cyber attacks. Not nuclear attacks, it's cyber attacks. So the more China, America, France, Germany, India invest in Australia, that's the best security you can have. And we've got a hint of that with America. So I just throw that out there. I don't know why. I was interested in it. I hope you are too. Australia's had a per capita recession, and what the budget tonight's going to talk about relentlessly is about the cost of living. And all of a sudden, here comes the coffee break. You want me to break? Does anyone want me to break? It's only been 2 minutes. Australian factors influencing 2025. I just went on a diatribe about China and all that, so that may be in the final release of this presentation, maybe not, who knows. But in terms of tonight's budget, we're going to hear a lot about the difference between inflation and the cost of living. There's no doubt that inflation does not reflect the cost of living, or indeed the cost of doing business, okay? So there's going to be a lot of cost of living relief tonight in the budget. And the question is, you go back 12 months ago, and you remember when we talked about cost of living relief through the budget, that all these, for want of a better word, know-all economists came out and said, you can't do that, you'll create inflation. Now, I could never understand how reducing the cost of living was going to create inflation. Does anyone explain to me? No one could, because it actually brought down the headline rate of inflation when you reduce the cost of electricity. We're going to have this issue tonight about cost of living and inflation. And they won't talk much about the cost of doing business. The biggest issue for cost of living is the cost of energy, cost of petrol, cost of healthcare, toll roads, all these things, and particularly mortgages and rents. They're the biggest influences on the cost of living. But how they are put into the inflation is anyone's guess. As I said last year, when you reduce the cost of living, what you did is you put downward pressure on wages. If people got a cost of living relief, then arguably they wouldn't ask for a wage rise, and then wages wouldn't go into the cost of doing business, and then you get the circular effect of it coming back into inflation. Yet every economist, other than this one, said that cost of living relief was not fighting inflation. It clearly was. Now, the Treasurer and the opposition leader have an opportunity this week to make it very clear to the people of Australia how they can improve the cost of living for a budget which is bloated, and we'll talk about the budget later. It's a bloated budget. There's a lot of opportunity to reduce the cost of living and also give tax relief in this country to people who need it. In terms of other big issues, in forecasting, I think interest rates will come down this year, not dramatically, but they're on their way down. The issue we have is the currency and the connection with the Aussie dollar, and the super funds of Australia who relentlessly sell the Aussie dollar. I think I've been through this with you before. Relentlessly sell the Australian dollar to invest in America. Constant pressure on the Aussie dollar. There is no logical reason why the Aussie dollar is 63 cents other than the industry funds of Australia can't invest money in Australia, so they export money out of the country and sell Aussie dollars and buy foreign currency. That's the great travesty of our superannuation system. And I'll touch on that a few times. We are raising way too much in super, not so much in this room, but there's way too much going into super without a logical place for it to be invested in. And that's causing this weakness in the Aussie dollar. Now, we are going through an interesting period where everyone's concerned about Trump and crises, but I would say to you crisis is normal, and there's a few instances of it. Only in the last 12 or 13 years, it's been a constant. You know, and you can go right down that page and you'll recall them, okay? No, we had the COVID scare, which surely you all remember, and then the inflation scare, which we're coming out the other side of. But go right back to 2011, which we might have forgotten. That was a real crisis in Europe where people were lining up at ATM machines in Greece and couldn't get their money out. That's a real crisis. That's one step away from depression. We're nowhere near that in the world today. So if you think we have a crisis with Trump, just reflect as you go through there how more significant crises can be. Now I'm going to go into some charts now and just see where we end up and see whether some of my opening comments can be verified by these charts. In terms of economic activity, yes, there has been downgrades to world growth, but we still have significant world growth, or economic growth in places like India and China. Now, in the back of your mind, always keep the number of 100 trillion, because 100 trillion is the world. That's the world's GDP. And we're talking at China about $18 trillion economy, and India a $4 trillion economy. This is US dollars. So we're talking 22% of the world with 2.5 billion people growing around a 5%. That alone ensures that the world's going to grow. Okay, just that alone. And it puts the question mark, and I said this to you last time, those of you who were here, why isn't Australia engaged with them, more so with India, and why are we so worried about engaging with America in terms of trade, not defence, trade, okay? And it comes down from leadership. We are totally misled, or poorly led, by our leaders who don't seem to have a vision for where Australia should be or could be. In terms of the rest of the world, as you can see, the world will grow at a reasonable clip. Probably the 3% is now going to come back to mid-twos, okay, because of America, the Trump pullback. The rest of the world will probably be stronger growth because of Trump, as I explained in the opening remarks. I said this last time, I love it. And why I love this is I did a little short, or George did, he cut this little bit from my last presentation, and it got, was it 400,000 views in India? Yeah, 400, huh?
India and Britain.
In Britain?
Yeah.
Oh, really? But the Indians loved this comment because they were playing cricket against Australia, and I said, why are India on the wrong side? Why are they on the BRICS and why aren't they on the G7? There is no logical reason, and I always check myself, they surely are in the G7. They are the fourth largest economy in the world. Why aren't they in the G7 if the G7 represents the largest economies in the world? It doesn't make any bloody sense. And India speaks English too. That helps. And they have English law. That helps. But we don't get them into the G7. We let them trade over there with the BRICS, with Russia and China, you know, and South Africa. Indonesia just joined the BRICS. Did anyone know that? They've joined the BRICS. That's what they think of it. They didn't want to join the G7, or maybe they're too small. But why are the G7 allowing the BRICS to develop and have China and now India as dynamic economies as part of that part of the world? Why does Australia sit back and say, oh, we're a G7, we're not a BRICS nation? You know, ex-Russia, which we don't like, obviously, and probably South Africa, you know, sorry Garth, you know, we don't like them either, but the other guys are full of growth. I just wonder whether Australia's on the wrong side as well, or we're on the reserve side, we're not actually in the side. I told you about the 100 trillion number and it pops up again. What's world government debt? It's $100 trillion. So in layman's terms, we have world debt to world GDP of 100%. Inside that, we have some countries who have more debt than their GDP and some countries which have less debt than their GDP. Now, if you ask a travelling Martian who's coming by Adelaide and say, would you rather invest in a country which has less debt to GDP than more debt to GDP, even a Martian would tell you I'd rather invest in a country which has less debt to GDP. And you'll notice on that Australia doesn't appear because we have one of the lowest government debt to GDP in the world. Yet tonight, the Treasurer, and on Thursday, the opposition leader, will wax lyrical about how they can manage the budget back into balance and they can control Australia's burgeoning debt, which may hit $1 trillion in a couple of years' time. Government debt, that is. $1 trillion is only significant because it has the word a trillion in it. Its relevance to an Australian economy, does anyone know how big the Australian economy is today? It's 2.7 trillion. So $1 trillion government debt and $2.7 trillion, it's not that much. And guess what? Australia will be a $4 trillion economy in probably 5 or 6 years' time. Okay? When you put it in context, and I'll come back to the budget, spending 10, 20, 30 billion dollars on projects is not a lot of money. Yet if you talk to a politician, they think it is. They actually think that's a lot of money. And they're trying to convince you that it's a lot of money. But we'll get back to that when we analyse the budget a little later. But you can see there's some interesting, the Japan. Now I look at that and say, how is Japan still with us? How is it not imploded with 250% debt to GDP? How could that be? And the answer is in quantitative easing and printing money. And I've been through this with a lot of you before in my presentations. No one can explain why this works, because it shouldn't work in economic theory. We should have hyperinflation in Japan, and the one thing we don't have is hyperinflation. Okay? Now in America, you would have picked up maybe in the recent week that the Federal Reserve, which is a big owner of American government debt through quantitative easing, was selling its bonds back to the market, and it just suddenly decided to reduce its selling. That tells you it's worried about the situation in the bond market in America. Okay, we'll get back to that shortly. So the issue about debt to GDP is this, and what you won't cover tonight in the budget, there's no reason why you want to have a balanced budget if you can borrow and grow the economy quicker. The important ratio is to look at economic growth to debt growth. If the economy is growing faster than debt, you are getting a very good return on your debt. If your debt's growing faster than your GDP, you're not getting a very good return. Unfortunately, what we're seeing in America, and what seems to be not picked up, is to get their growth rates of 3 and 4%, they've had debt growing at 5 and 6%. So they've been getting a 50 cent in the dollar return for debt. Government spends 5% of GDP and the economy grows 2.5%. The other issue is that China has now slipped into the same category. It's growing its government debt faster than its economy. Now it's only been going for a short period and maybe it can pull back from that, and some of it's to do with its property market, but that's an issue which we have to watch. Not so in India at this point in time. India is growing its economy much faster than its debt. And when you look at the bond market, who owns American bonds? So America has about $34 trillion of bonds. Well, the biggest owner is the Federal Reserve, which is the central bank. So the central bank printed a lot of money. The American government had big deficits. The American bond market, or the bond market couldn't service the American government, so the Federal Reserve stepped in, printed money and bought the bonds. Okay, so it's now the biggest owner. And as I said to you before, there's never been a point in history or a historical precedent where the Federal Reserve or the central bank of a country has put the government into receivership. Never, I can't find one. I've even looked at the Bible, I couldn't see it. So it just doesn't happen. So if you're going to have a creditor who's friendly, make sure it's your central bank, because they'll never call in the loans. So that's a bit of a protection. But if you rocket down there, pension funds, state governments, blah, blah, blah. But who outside America owns the bonds? Japan, China, United Kingdom. Now, Japan, China, and United Kingdom, I can assure you, haven't bought a bond in America in the last 5 or so years. China has been selling bonds recently. So foreign interest in American bonds is virtually zero, which makes you wonder what Australian super funds are doing when we invest in America. What are they investing in? We don't want to buy the risk-free asset of America. What do we want to buy? So that's a bit of an interesting chart, you know, because I'm often asked, who owns these bonds? Because you tell us how bad they are, John, but someone's buying them. It's mainly people who have to buy them. It's maybe entities who are regulated and they have no choice. If they had a choice, they wouldn't. Now, I said earlier interest rates are coming down, so interest rates have peaked, but the more interesting reflection is comparing interest rates to inflation. So it's all right saying interest rates are coming down, but they're coming down at a faster or slower rate than inflation, or they're coming down at a slower rate than inflation's coming down, but they are coming down. But remember, they went up slower than inflation went up when they went up. So you remember that in Australia, for instance, you know, we went to inflation, I think nearly hit 7 or 8%, and our cash rate went to 4 from near 0. And now our cash rate's 4.25, inflation's come down below 3. So we're slow going up, slow coming down. Inflation went on a much different tangent, but it's a worldwide phenomena that interest rates are on their way down. But what this is capturing is we're creating real interest rates again. Now, real interest rates are important. When you get paid interest greater than the rate of inflation, that's not a bad place to be. And what Michael said in his opening remarks is we can do passive investing, and today we can get passive returns above inflation. Bank deposit rates, term deposits above inflation, but that's not adequate because, as I also said in my remarks earlier, inflation doesn't reflect the cost of living. Okay, so you can beat inflation, but that might not help you against the cost of living increases because they're lying. They lie about the cost of living. Anyway, so we need to do better on our investing in terms of cash returns, and that's where the unlisted credit market, corporate bonds come into play. Now, America's got an interesting problem, and we know Trump is closing the borders with his neighbours, Canada and Mexico, and they've complied, as I understand, they're complying and stopping the influx. But that's going to have an effect on the number of people in America aged in the working age group. And so we've got these funny charts appearing. The Western world is ageing. The Western world is not replacing itself. And it's also reflected in America and Australia. Birth rates around the Western world have declined dramatically. They've declined dramatically in Australia. We're now below 2. Okay, so we're dropped dramatically. Korea's dropped dramatically, there's another one. But America's dropped dramatically. But both Australia and America got around it by immigrating people. We immigrate people to offset the slowing birth rate. Now, the birth rate issue is definitely a cost of living issue. You know, if people can't afford to have a family, they won't have them. Now, they won't hear that in the budget tonight, the admission that we've stuffed up our demographics and why we need such rampant immigration to make up for the shortfall in population in the working class, okay? It's all related. Now, Trump is going to stop the borders of America, stop Canadians and Mexicans coming through, but apparently a lot of those people were working in America, you know? The incumbents weren't, we immigrate. It's a bit like Australia. We don't work, we just bring people into work. You know, that's what we do. So it's a bit the same in America. But they did it illegally in America, you know, that was the problem there. Anyway, so I just make the point, there is a lot of work being done. It's going, oh, hold on, if we do close the borders and close down immigration, what's that mean longer term for America's growth? And America is a rapacious consumption economy. So if you start slowing consumption, it'll have a knock-on effect in terms of the whole economy. So it's a big issue. Now, the other big issue is Trump, and you know he's got Elon there helping him to balance the budget. He's starting with a $1.5 trillion negative, so he's a long way from home. And $1.5 trillion, oh, I can do my numbers again. That's about 5% of America's GDP deficit. Like the Treasurer tonight will crow about that the deficit this year in Australia will be 0.5, 0.6% of GDP. But we need to do more. Why? America's got 5% deficit. They don't want to crow about it. They have to do a lot of work to get it down to balanced, and they'll never get there, okay? So they've got a $1.5 trillion deficit, And the big issue about America, and I think I told you this last time, when you start looking at the bond market of America, which is 30 odd trillion, and we look at the interest rate, America's interest rate on its bonds is averaging about 2%. So if you do the bonds and put an interest rate through it and put it through the budget, they're only paying 2%. But if you look at the bond market in America, it goes from about 4% to 4.5%. So how are they paying 2%? Well, because they issued all these bonds pre and after COVID, a lot during COVID, at zero. So there's a lot of bonds there which aren't generating interest. A lot of them owned by the Federal Reserve, by the way, who aren't getting interest. And so what's going to happen over time is these bonds are going to mature and roll into new debt. And guess what? The interest rate's going to go up on the total bond portfolio. The cost of debt's going up in America. Interest rates are going to come down, yet the cost of debt to America is going to go up, the government. So they've got a real problem on their budget. And as someone said recently, I actually said it first, but someone else then said it, is that the interest and the national defence budget of America are about the same now. America's spending as much on paying interest as it is on defence. And we need their money in defence because we can't help ourselves. We can't defend ourselves in Australia. That was sarcasm. Just in case. How big is the interest bill? Well, it's begun to rocket, hasn't it? And it's gone up dramatically. And this is the effect of debt rolling. So you can imagine it was under 2%, and as it rolls up to 2, 2.25, 2.5, 2.7, as that interest gets rolled, as those bonds roll, that blue line starts rocketing. Okay, that's why I said about, was it no, it was only about 15 minutes ago, I said, Trump has to get the oil price down, to get inflation down, to keep the bond yield down, the cost of bonds down, right? That's not a headline strategy of his, that's my reading of what he's trying to do. He wants to oversupply the oil market of the world. He wants to make America self-sufficient, to get the cost of energy down in America, to get inflation down, to try and hold this interest bill down as debt is rolled. It's a big play. America runs massive deficits. If you think about Australia, we have, until tonight, the budget, but we did have a fiscal surplus, a trade surplus, and we almost had a current account surplus. We almost got the trifecta. America has a fiscal deficit which you can't pay back, a trade deficit which Trump's trying to tariff away, and a capital account deficit because the rest of the world is investing in America and taking income out. So why is the American dollar so strong and the Aussie dollar so weak? I told you that before because we sell the Aussie dollar for our industry funds. America has every criteria is quite poor. So when Trump says, I have to fix this, he's absolutely bloody right. That is a massive problem. It's a massive problem. Now, is tariffs the right way of doing it? Well, it's a start, okay? But from an Australian perspective, do we have to get caught up in the emotion of all this? Do we have to watch this every night? I guess we do. Otherwise, we're watching maths, aren't we? If we're watching maths, we're not watching the real world. But it is a show. The American administration has to fix this, okay? And it's going to be a very difficult fix. And it might be that he has to slow the American economy right down. But the problem when you slow an economy down from a budget perspective is the economy pays less tax to the government. And he wants to cut taxes. If he cuts taxes and the economy slows down, the deficit gets worse. Doesn't fix the problem, makes it worse. He might fix the external trade account, but he won't fix the fiscal account. So I'm a little bit confused. And I'm not the only one confused because you might remember about a week or so ago the Federal Reserve put an interest rate update out and they didn't move interest rates. And the head of the Federal Reserve said he was confused. So I'm not alone. So if you feel confused, don't worry. The smartest guys in the world are confused. So if they're confused, you should be too. So don't feel, insecure about that. Now, Trump is on about the trade with China. And last time he had a crack at tariffs, it was around here. He got the deficit down and then went up again, because America can't produce what it needs today. To turn the American manufacturing base around, to replace what China supplies at probably half the price, is a massive effort. A massive effort. And he's trying to price China out of the American market, but the problem is, as you know, you create inflation, right? And not only is he talking about what I call primary tariffs, which is direct tariffs, he's now got secondary tariffs. You've heard about the secondary tariffs, and there's an article this morning about, I think, freight coming out of Germany. He said, if you use a Chinese manufactured ship, I'm going to hit you for 25% tariff on arrival of the goods coming off that ship. Now, who thought of that one? That's something which you think would come out of Canberra, you know. But they've obviously got Looney Tunes in America. I mean, that is the most ridiculous thought process there could ever be. So what is Germany saying? Well, if that's your rule, we can't actually load the ships in Germany because the guys who are buying this stuff can't afford to pay it when we land it in America. So it's just stored. There's a huge lot of trade which is stalling at the German wharves going to America because they don't know what the price is. So you watch that backtrack in the next week. You go, I was just floating the idea, see what happened. But they're dumb ideas, some of these, okay? I'm not anti or pro-Trump, can we get back to common sense? Okay. And tariffs is not about balancing the budget. It's not going to balance the budget. Tariffs are a very low, is this a protest walkout? No. I tend to offend young people. I'm sorry, the older people are staying. Yeah. Now we've got the age we just went up. Our average age just went down. Mature, sensible people stay. The young people can't take it. That's okay. The American budget is what? $7.5 trillion. So we're probably, add all that up, you're probably talking, I don't know. Well, that's individual taxes is $2 trillion. Where's tariffs? That's what it is. Income, customs duties, $80 billion. Yeah, not much. Excise taxes, 76. It's nothing. They don't get anything out of tariffs, okay? So what, he raises a couple of $100 billion? Is that going to solve the $1.5 trillion problem? Probably not. He's going to cause 1 or 2% higher inflation. So it's not the panacea. And then on the other side, sorry, not on this same side, what do they import? When they put up these prices, what does it hit? Passenger cars. Pharmaceutical preparation. I can't believe that. So all these big pharmaceutical companies, they might own the IP, but they don't manufacture in America. It's manufactured everywhere else. And I was stunned the other day. I think Australia exports $2 billion of pharmaceuticals to America. I didn't know that. You know, has anyone been to hospital lately? Oh, come on. We all have. We've all got problems. Did you know we were out of intravenous drugs? Only a 2-week supply in Australia. I was in hospital about a year ago, and for 3 days I wasn't on saline. And I'm burning up, you know? And I didn't realise that we'd run out of saline in Taree Hospital. I could have died. This could have been cancelled. You're probably thinking, why didn't he? But, you know, what the hell is going on in Australia? Anyway, that's a sideshow. Don't worry, sorry, got off the track there. So this is what America imports, and this is the thing there. That's coming out of Canada. So all that crude is coming out of Canada for refining in America. So again, I say, I don't think he's really thought about this greatly. It's a great idea to put tariffs and tariff away the trade deficit and try and get economic growth inside your economy to help you balance your budget. But it's a very long process, okay? And he's only got 4 years, I think. He's only got 4. Yeah, so he hasn't got, yeah. So let's just see how this plays out. Is my comment. I think there's going to be a lot of pivoting. I don't think this is going to be sustained. He's already talking about, I think we might even be on the good side because we have a trade deficit with America. He's now saying if you've got a trade deficit, don't worry. So he's already backtracking at 100 miles an hour. So let's just carry on. And as I said earlier, I think he's being told, and I don't know who he listens to, that if he keeps on going, he will force trade blocks to be developed, you know, outside America. And America won't be invited in them. Europe has already got one, and Asia Pacific might be Asia Pacific ex-America. Stuff like that. So, interesting in terms of the Asia Pacific region, who does it hit most? And it's mainly Asian countries where China uses as a manufacturing base, so outside China. So this happened in 2016-17 when he did it last time. What did China do? It moved its manufacturing to other countries. So Vietnam, for instance, Malaysia, Thailand, you know, they're all mainly Chinese capital, Chinese owned, okay? Of course, the others are his nearest neighbours, Mexico and Canada. Australia, as you can see, we're the little red one down the bottom. We have so much to fear. We get ourselves in a knot over nothing. This is the point there. So let's put it in. I maintain that this is net positive for growth outside America. Now, having said that, America has really outperformed in terms of productivity, and this will come down later when we talk about Australia. America's productivity improvement cannot be denied. So, if you believe this is Bureau of Economic Analysis in America, the improvement in productivity in America has been the main driver over the last 5 years. And compared to its Canada, the Euro area, United Kingdom, well, United Kingdom's picking up because they had a recession. Amazing what a recession does in terms of productivity. America's performance in terms of productivity, labour productivity, has been outstanding. So when I look at the American stock market, yes, there is some elements which are very hard to understand, but underlying that, there is a significant improvement in labour productivity and therefore profitability of American corporations, okay? And we believe that's going to have another leg up through AI. There's another leg to American productivity. The question is, will they share it with the rest of the world? That'll be interesting. We do know that China will share it.
What makes them so productive, John?
America.
They just work harder, or they just go, America, and just do their work?
Oh, I think they've had a benefit greatly from immigration. You know, they do, apart from Mexico and Canada, I shouldn't say that. I think they've immigrated entrepreneurs into America. That open, having a dynamic market, having a capitalist system which rewards intellect and endurance, so a very good reward system, has attracted the smartest people in the world to go there. And you've seen, even Australia, some of our great IT companies have just left Australia and gone to America. That's embarrassing, you know. So I think that's what's caused it.
Cheaper labour as well in America.
Yeah. Not cheaper than China.
Is it, John, that they moved out all their cheap labour industries? So
Yeah. Well, they had
changes the average.
Yeah, well, the IP stayed in America, and then they manufactured offshore and particularly used China, and now they're trying to reverse that.
So that gives you a productivity advantage.
Yeah, absolutely. But there is more to come. Well, computers was the first, you know, the industrial revolution extension through computerisation, and now we get this extension through AI. Okay. Now, there's the big question: is there a correction coming in the American dollar, US dollar? Answer is I don't know. I can give you every reason why it's overvalued, but that's not a reason why it's going to fall. Observing overvaluation, as we know, gives you probably a good 10-year view, but a short-term view, it's interesting. That's all you can say. But there's no doubt the American dollar is overvalued.
Can you relate that to commodity prices?
Well,
In Australia, most of the commodities are priced in US dollars.
yeah, so we're a net benefit, and tonight we'll get it through the budget. We'll say that we underestimated the price of commodities, and we got a windfall for 2 or 3 billion coming through the budget. So in iron ore, we're now getting a surge in copper and gold, you know, because they're US dollar. And then when you reflect back in Australia, we've had astronomical increases in some of these commodity prices, you know.
Yes, but if you're seeing a reduction in the value of the US dollar versus the
If it ever cracks, yes, you're right. Well, the US dollar will crack, the US price will go up, and the Aussie dollar will go up. It's hard to read, but I don't think it's the end of the world if the US dollar cracks. Is it going to happen anytime soon? No. But what Trump's done, and I actually think he wants to get the US dollar down. If you have a America First policy to drive out imports, replace imports, a weak US dollar is obviously your policy. And in a absurd way or strange way, if he can get Europe growing faster than it has and make Europe a legitimate destination for capital, and capital flows go back to Europe, it'll devalue the US dollar. Where we have now, and you can see it for Australian super industry, we just default into America because we haven't got much alternative. We haven't got much opportunity. Now, admittedly, they're not thinking. the industry funds. They don't think, they just default. There's wonderful opportunity in India and China and Indonesia and Malaysia, Singapore. You know, that's where most of our export capital should be going, not to America. But who am I to say? Now, this is my point earlier about what this could mean for Europe. And we've had the ultimatum to Australia, and we'll see what happens tonight in the budget. You know, whether we're going to increase defence expenditure. But Trump through NATO has said, no, 1.9% is not enough. We want 3.5%. So that's about $500 billion investment by the European Union in defence. $500 billion. And the beauty with guns and bombs and all that, if you want to see the good side of it, I know it's very hard, so just close your eyes for a sec. It's all made of steel and iron ore and copper and aluminium. There's all these commodities which Australia is so proficient in. All of a sudden we're a net beneficiary. So the market of these commodities starts growing again outside America, okay? So in an economic sense, this is good news for the world. It's a terrible way, it's a terrible way to invest and benefit, but the industrial base of Europe will have to be reinvigorated through this edict. So is that bad news or good news? No, I wish they were building hospitals and bridges and roads rather than bombs, but it is good for the industrial part of the world, okay? So again, I'm not trying to be bullish or overly optimistic. I just think there's some other sides of the story here, and we shouldn't get too down on it. Now, if we were going to have a break, I was going to have the break now, because I'm going to go to Australia, and I thought this was funny. Have we crossed the red line? Anyway, sorry if that offended. Does anyone get offended by that?
Absolutely.
So I don't want to read about you. I don't want someone putting a blog out there. I was so offended when John put that thing up about the massage. Anyway. Okay. Now the budget tonight is an update of the mid-year budget. Okay, and the mid-year budget, as you know, came out just before Christmas. And in that mid-year update, the budget forecast of $28 billion deficit was slightly improved to 26 to 27 billion deficit. So the Treasurer put it out quickly about a week before Christmas and then went on holidays. But he forgot about Katie Gallagher. Katie Gallagher's the Finance Minister, and she came out on Christmas Eve and said, oh, look, 27 billion is probably more likely going to be 10 billion deficit. The budget is running 15 to 17 billion better than we forecast, and even what the Treasurer said a week ago. Now that didn't get much news coverage because it was Christmas Eve. So tonight we're going to get backtracking at 100 miles an hour, trying to work out how much of that good news which was hidden he's going to give back. So he's got an ambit range between 27 billion and probably 10 billion. Now he'll probably pick a midpoint, and don't shoot me if I'm wrong, somewhere between 15 and 20 billion will be his budget forecast deficit. Only because he's wasted billions of dollars in promises. Now, but I don't know, some of these promises may not start to July 1. i.e., why promise something to get a vote and give it to people? Because if you give it to them before they vote, they'll forget about it. They just take it and put it in their pocket. You've got to give it to them and they have to vote for you to get it. And if he does that, then all these giveaways won't start to July 1 and it won't affect the budget. Then he'll say, okay, I've got a budget of $12 billion deficit. How good am I? I'm a fantastic manager of the economy. Okay? The fact that we got it wrong, and where did they get it wrong? What did Katie find that Jim didn't see? Well, knowing that Katie can't read and Jim doesn't know, the answer lies in the fact that Australia employed, on average, 1 million people more than we forecast in the budget estimates. You can't immigrate 1 million people and expect that they won't be working. So I shouldn't say 1 million people worked. It was hundreds of thousands of people joined the workforce, which the budget didn't pick up on. And those people join the workforce, earn wages, pay taxes, and the tax collect in this year's budget is 10 to 12 billion bigger than forecast. And that's after they gave you a tax cut on July 1. So the boffins in Canberra completely miscalculated the budget. They knew they immigrated people, they knew the workforce was increasing, they knew there was inflation in the wages system, yet they got it wrong in terms of calculating the amount of money that's been collected by the government. So it's interesting. So tonight's, I'll be watching very quickly, one of the things I'll be watching is obviously this budget forecast for FY24 and of course, FY25 and of course the outlook for FY26. And of course, you know what, the FY26 is going to be terrible. It's a terrible outlook. Why would they have a terrible outlook for FY26? Because it stuffs the opposition. The opposition can't promise anything because it can't be budgeted. You can't fund it. So if I was the Treasurer, I'd say, we've done better than we told you. It's a better budget outcome. That proves how good we are. Oh, but next year's terrible. Shocking. Don't trust the Liberals. If anything they promise, you're going to pay for it. We pay for everything they promise. That's standard. Yeah. That's a little background on the budget. Tax revenue is running higher than forecast, so this won't make much sense to you, but as I said, the revenue, even after 5 months at the end of November, was running $10 billion better than expected. Okay? My point is they're consistently wrong. Why is Treasury so consistently wrong? And you've heard about this windfall. I was just reading the paper this morning, and the Labor Party is so good, they've had a $200 billion windfall under the budget estimates under Liberals. No, the budget estimates were wrong. It's not a windfall. They miscalculated. Okay, that's not good management. That's bad. That's incompetence in Treasury. You know, but they'll spin it to make you think that they're much better than the other side, because the other side, advised by Treasury, said they were $200 billion worse off, but the same Treasury advising this government has found $200 billion because they miscalculated. It leads you to work out, well, what else is miscalculated? So the underlying cash balances over the forward estimates have been wrong by $144 billion. So that's the current underlying cash balance over the forward. So that's not the point I was trying to make. The point I was trying to make is, do not believe any numbers you see tonight. They're going to tell you that the forward estimates are $140 billion worse than they forecast 6 months ago. Bullshit is my answer. Do not believe anything the government tells you tonight. And it doesn't matter, even if the Liberals are the government, you wouldn't believe it, because the Treasury is incompetent and they're lying to you. Okay. The Australian budget is actually fine. There was half a chance if the government, if we didn't have an election this year, right, if we didn't have an election, there was a chance that the budget could have actually been balanced. Okay? It could have been balanced. That's how good revenue is coming into the Australian government. Yes, they're spending a lot of money, but they're also collecting a lot of money, even though they gave you an index tax cut on July 1. If they didn't give you the index tax cut, the budget would have been massively in surplus. Okay? But they had to give you a tax cut. Why? Because an election coming up. The tax cut election cycle, they call it. Now, the other issue is government expenditure promoting growth? To an extent it is, but I told you earlier that America and China are running deficits lower than their growth and debt. I said that to you. Australia's growth is much higher, our economic growth is much higher than our deficit. So we'll probably say, give or take, that we're running a 0.5% deficit tonight, but our economic growth will be something like 1 to 1.5%. So Australia's economic growth is 3 times our deficit, okay? Which means our growth is 3 times our growth in debt, government debt. It's the same number, okay? So we're actually, when you look at it, we're actually doing much, much better than the rest of the world. Much, much better. It feels terrible. We have a cost of living crisis, so that's just bad management by the government. I'll talk about that shortly. But in terms of economic activity, we're okay. Unfortunately, it's not government expenditure which is creating the growth. It's helping, because a lot of the government expenditure is going down a black hole. It goes down social security black holes. The best expenditure is coming from immigrants. We immigrate 1 million people over 3 years, and a lot of them work, a lot of them get jobs, they earn money, they pay tax. They create economic activity, they consume, they demand. So the income tax take is rising. Why does it rise? Well, this is a percentage of GDP, it's not an absolute number. So this is just saying, why is tax going up? Because they don't bloody index it. It just doesn't get indexed. We go through bracket creep, exactly. It's got nothing to do with anything other than the government's refused to adjust the tax rates until it's election time to get your vote. And that's why the Labor Party, this time as the government, and it was the Liberals before, they hoard all this revenue and then they release it if you vote us back in. You can have it. You can have your electricity relief. You can have another tax cut. You can get your childcare allowance. You can get your free pharmaceuticals. They build it up and it's the worker who's being hammered. And that's the problem with the tax system. We tax people who work. We need people to work to get economic activity. We don't tax passive capital. We'll get back to that. Australia's budget position is far superior to our peers, as you can see. Yes, this is a bit historical, where our blue went to above zero, so we had a budget surplus and no one else did. And even in our bad time during COVID, where we hit 5% to 6% deficit to GDP, we're nowhere near UK, Germany or Canada, who now we can look at the true numbers, went well above 10% deficit to GDP. Okay? So, you know, if we had a 10% deficit, our deficit would have been $250 billion. Okay? We came out a lot better out of that. It's amazing how good we are, you know, with the idiots running the place. It shows you how resilient the Australian economy. And why was the Australian economy resilient? Because we're an export economy. We're a commodity export, so we were sheltered. The local economy, we can all go to sleep and the country still makes money. What a beautiful place. Now, the cash rate mismanagement I put up here, well, the mismanagement is not putting interest rates up. The mismanagement was putting interest rates down so aggressively. So you sort of have to go back to COVID when we're all panicking together. A lot of panicking at home as we were locked up. But while we were being locked up, the Reserve Bank pushed interest rates down towards zero. And that was a ridiculous thing to do in retrospect. Yes, we could all support it because we're all panicking, but it created a major problem. As we came out of COVID and inflation appeared, they had to really ratchet up interest rates. And it became a very bad mismanagement because you remember the central bank at the time told you interest rates are going to be zero after 2024, or 0.1. So they conned a whole lot of people into borrowing a lot of money they can't afford to pay back to buy a house they can't afford to live in. That's the mismanagement of it. So it's all right playing with interest rates, but if you don't control the creation of credit, you create a major problem. And that's the problem of Australia. And Michael sort of touched on the changes to banking and the capital rules in his little speech. Australia, the mismanagement of the financial system of Australia is appalling. And the ramifications for our kids and other future generations, I'm sorry he didn't stay to hear this because I was going to give him a pat on the back. You know, the issues for young people are terrible, terrible. And here we have these politicians telling you how they're going to make housing more affordable. Well, I'm pretty simple. The only way to make housing more affordable is have a massive increase in wages, call it 50%, or a massive decline in the cost of housing. There's no other economic way to do it. So these politicians talking about they're going to make housing more affordable by creating more supply, it's bullshit. And they should be called on it. Unfortunately, only people who seem to have something different to say is the Greens, and we can't vote for them. Did I offend someone? If I offended someone, bad luck. If you want to vote for them and pay 50% for your superannuation, go ahead. Okay. Now, Australia's had some benefits because one of the reasons our inflation rate's down because China's back exporting deflation. Before COVID, China deflated the world. One of the reasons why we printed money aggressively but we didn't have inflation is because China was exporting deflation to the world. And that's what Trump's trying to unwind. It was good when it benefited America to get cheaper goods from America, cheaper manufacturing, but now, oh crikey, we have no manufacturing left in America. So, but come in spinner. Australia has no textile industry. We have no white goods industry. We have no electronics industry. We have no car manufacturing. We are a mini America. We did the same thing. We said, go and manufacture it for it. We don't want to do it. Okay? So we've both got the same problem. But at least we're saying, okay, we're never going to have a manufacturing industry. Keep on supplying cheap goods. America's saying, we want a manufacturing industry. Put tariffs on it. That's where we part company in terms of economic management and trade management. if that makes sense. But that inflation down is still occurring. I mentioned earlier about why the Aussie dollar is weak. It has nothing to do with economic fundamentals. It all has to do with capital flows. Australian industry funds, and it was in the paper again 2 weeks ago, Australian industry funds went to the US superannuation conference. Crikey. And then they got hauled into the Senate to justify why they were there and how much they spent. It was how ridiculous. But America, what was disclosed there, Australian superannuation now has, I think, about $480 billion US dollars invested in America, about 700 billion Aussie dollars. But there's more. Their target is to have $1 trillion of US investments by 2035. The Australian industry funds want to have $1 trillion invested in America. Now that's a great forecast or target when America is dropping tariffs on us left, right and centre. So we want to invest in a place who's going to hammer us. How illogical is that? And they go, well, where else can we invest it, John? Where else can we invest it? You come up with an idea. Well, how about we not give it to you? Then you don't have to invest it. Or if you want to invest it, how about you buy the Australian bond market? Okay, how about you invest in Australian bonds and fund our growth, not America's growth? What's wrong with that? It's only $800 billion, and we can take all the debt of Australia and house it in Australia. So we're not paying interest to foreigners. If you don't pay interest to foreigners, it stays in the country. That's not a bad outcome, is it? Or am I missing something? You see the brain dead way we run our capital markets in Australia? Oh, we need to borrow offshore. Why? In 2045, the superannuation industry of Australia will be $15 trillion. And the Australian economy will be 8 or 9 trillion. What are we going to do then? You know, we've got to stop this nonsense, okay? That's something you won't hear tonight in the budget. I just put this up because economic fundamentals says when you have a trade surplus, you have a capital surplus, your currency should be strong. That's what I learned at university and school 10 years ago. My mind's gone, sorry. A long time ago anyway. That was basic economics. The whole thing's being stuffed by quantitative easing. None of the old rules of economics work. So when you listen to economists, if they don't admit they can't explain it, don't listen to them. I have no idea what I'm talking about. You should continue to listen, is what I'm saying now. So the trade situation does not explain why the Aussie dollar is so weak. Okay? It's all to do with printing money and so much money going into the American economy, which is consuming it. And the Australian superannuation industry is part of the problem. We have 2% of the world's population and have about 4 or 5% of the world's superannuation. Why? I don't know. The big problem is, I've told you this before, so I'm going to rush over it. Our problem is not government debt. Despite what you hear from the Treasury tonight, it's not government debt, it's household debt. The mismanagement of our mortgage debt, the dropping of interest rates, the encouragement of young people to borrow aggressively to buy a home. We're wearing it now. We have over $3 trillion of household debt. And if you look at, and I know no one in this room has any debt, he did, that's why he left, he was embarrassed. But I love it when someone leaves, I can really go for them, you know, he's got no recourse. Okay. He won't even, he'll pick it up on TikTok, that's what okay, sorry. Can we take that out of TikTok, George? Our problem is household debt, and tonight, again, you will not hear anything in the Treasury to work out what we should do. And clearly what we should do is have some sort of means testing which allows rent to be a tax-deductible expense for some people, and for some people, mortgage interest should be a tax-deductible debt. Tax-deductible expense. We shouldn't be giving tax deductions for negative geared investment property. We should give tax deductions for people who are trying to live in their own home. As we work out the problem. Don't shoot me. Australia's mismanagement of interest rates, we've seen this massive increase in mortgage rates, which if we only had $1 trillion of mortgage debt wouldn't be a big problem, but when you have $3 trillion of mortgage debt and you push up interest rates 3 or 4%, do your numbers, all of a sudden it sucks out hundreds of billions of dollars of interest. That comes out of consumer income, that comes out of consumption income, and it causes a massive cost of living problem for those people who are borrowed. So the cost of living issue, which the Treasurer will mention, is very much driven by the fact that our administration, government and Reserve Bank encourage people to borrow a lot of money on the assumption that interest rates weren't going to go up. That's the major part of the cost of living problem. The other thing is we're immigrating a lot of people, and Australia's very good at planning. You know, we planned the biggest LNG export industry in the world and forgot to arrange supplying our own gas. And now we've had one of the biggest immigration programs in Australia's history. We grew our population by 3.5%, but forgot to build homes before they got here. So we are visionaries in terms of planning. We certainly know how to grow without success. And again, you won't hear this tonight, although the government will say we built 347 houses through the Housing Future Fund. A massive, but there's thousands that are coming on the market. Again, more bullshit, you know. But I'm being fair here. I think both sides of Parliament are hopeless in terms of housing policy. The only way to fix it is to get the bloody price of housing down, and that's very painful. Now, if you're retiring, hoping that your residential property is your way to... You got it. You picked it up. I think there's a lot of... I'm not giving any advice, but I think if you are in a very overpriced house, there are better ways. You should think about it. Anyway, that's your call. I don't care. Okay, but how much has housing gone up? This is terrible numbers. I mean, this is the 5-year movements, and we've had a 61% increase in the cost of housing from the median price in Sydney prior to COVID till today. 1.5 billion median. And if I take a ring out about from the centre of Sydney, forget about the eastern suburbs because they're off the Richter scale. You know, I'd hate to think what they're doing, but if you go west to the inner west of Sydney, it's something like $3 million median price of a home within 5 to 10 k's of Sydney going west. Now, who can afford that if you're a young family with 2 kids? What are we doing, you know? So they're going to have to borrow $2.5 million. If you're borrowing $2.5 million, do you really think you're going to pay that back in the next 30 years? Unless your parents die? If your parents die, you too can pay that back. He would have chuckled at that one. He did last time when I said it. Okay, so what has happened? And why I'm sort of thinking I think the housing market's pretty close to a top is this, because what's happened is the capacity to borrow has dropped dramatically. So this is just tracking. You can see that the price of land packages in Sydney, it's amazing, it's shot up to $1 million, but it's gone sideways. Why did it stop going up? Because the capacity to borrow and pay a ridiculous price has been cut dramatically. As interest rates have gone up, the capacity to borrow has come down, right? But the price hasn't come down. The gap's open. Why? Because it's all in the cost of materials and land. It's going to take a little bit longer for that blue line to come down. It's showing signs of coming down. It's not going up as much. We're probably going to see this blue line come down. Now, the government's hoping you can get that line up. Why? Why? We don't want that going up. We want that coming down. And that's, you know, no government's going to tell you wants the housing prices to come down because there's no votes in that. There's no votes in telling you we need the housing price to come down. Okay? So we have a problem. We have a problem which no one can solve. Australia's real income. So this is the big issue in the cost of living discussion tonight. Australia's, since I think the ACCC inquiry recently into groceries had a number like this, and it's come out over and over again. The cost of living since March 2020 is up by about 22 to 24% in Australia, and wages have gone up about 12 to 14. And there's your 10 to 12% drop, okay, in your wages to the cost of living. So that's the cost of living crash. Having said that, as I showed you earlier, I didn't have Australia up there, our productivity has not been as good as America. So our productivity is flatlining, our cost of living has gone up 20 odd %, and our wages have gone up 10 or 12% since COVID. And that obviously, something has to give, and it's called consumption. So real consumption has dropped. Consumption's growing, but it's not growing as fast as inflation. So there's more economic activity in Australia, but it's not as great as it could be if we just matched inflation. America's the opposite. America's wages have gone up with their productivity, and they've managed to increase their consumption. And the whole American economy has been quite robust in this period. But once you bring Trump in and you put up inflation, what's going to happen? Now already we are seeing signs that the American consumer is a bit worried. He's a little bit worried about costs going up. And there's two things you can do when you think costs are going up from the economic point of view. You can either bring forward consumption and buy now quickly before the price goes up, or you go, crikey, I better start saving some money, I better cut back on consumption. And at this stage it looks like the preliminary numbers are that consumption's falling in America, because there's more poor people in America than rich people. So they've got nothing much to spend, so they're going to cut back. So that's it. Let's see how this game plays out, is my point there. So real wages have declined. As I just said previously, Australia's wages have not matched inflation, but we're not bloody productive. We're producing less. And since COVID, we've produced less. Now, do you think that has anything to do with working from home? Is that a wind-up call? No, so it's a picture, sorry. There seems to me a clear connection between working from home and productivity. And the question is, why are we not surprised? Or why are we surprised? Why would anyone be surprised that working from home is more productive than working in an office? And get, huh?
Less, I think you meant to say.
I confused myself, thank you.
We know what you mean.
Why are we not surprised that I'm confused? Okay, hopeless. I'm rushing now because I know we're running out of tape on this video. Okay, now this is just comparing across the world the cost of energy. Now your left-hand side, Qatar, Nigeria, Russia, Saudi Arabia, Turkey, Venezuela, China. Look how little have their electricity prices lifted worldwide. This is measured in March last year, so about a year ago. How little their prices lifted over the previous year or so. Australia, however, who is an exporter of energy, so these guys are exporters of energy, and we're an exporter of energy. But we forgot, when we set up our export markets, to make sure that we had energy coming back to us, or we reserved energy for our... Okay? Now, these countries over here, some of which we don't really like, some of which we're going to have to like, whether we like it or not, they've just said, stuff that, we're not putting up the price of energy because we're just controlling it. And by doing that, they control their inflation, and they control their cost of living, and they control their standard of living. We had the same opportunity, but we didn't do it. Now, it takes years of incompetence to get to that position where you end up with a completely hopeless energy policy. And we're going to get this diatribe again this week and next week and the week after about energy policy. Don't we all wish that both sides of Parliament could just come together and agree on what's best for Australia? Because I'm totally confused. I will say this, that whether you like it or not, I'm not saying anything about nuclear, but think about this. I should have said this earlier in the budget. The Australian economy is 2.8 trillion. The budget tonight will be 700 to 750 billion. Now that's about 60 billion a month. That's about 2 billion a day the Australian government spends and collects. 2 billion, just go. Yet we're worried about spending $35 billion on a nuclear plant. When you put it in context, they say, oh, 35 billion, that's not a lot of bloody money over 10 years. That's $3 billion a year for 10 years. And the budget's in 10 years' time is going to be $1.25 trillion. The politicians love saying to you, it's a lot of money, trust us. They don't know what a lot of money looks like. But I'm telling you tonight, the budget of Australia will be well over $700 billion. So reserving some money to build an agreed energy policy for Australia, we can fund. There is no problem. Plus we've got $4 trillion in super. We have no problem funding anything. We can spend $450 billion on submarines which may never get here. We got over to America and gave them $880 million in a cheque. Non-refundable. He's $800 million. They're worried about spending $35 billion over 10. It's pathetic. Anyway, obviously, energy prices creates inflation. So I wrote in the Fin Review, and I didn't get attacked because I don't think anyone understood what I was talking about. Get energy prices down, you will get inflation down and the cost of living down. It's pretty basic economics. If you get the cost of living down, inflation will follow. Yet we had a whole lot of economists saying, if the government goes greater into deficit and gives everyone tax relief and energy relief, it's going to create inflation. Why? So many journalists just took that sort of brain snap and said, that must be right, it's being said by an economist, right? Do you believe everything that doctors or dentists tell you? I don't. Or your accountant, or just because we're economists, they can't be wrong. The most flawed profession is economics, right? And that bullshit about if we give people cost of living relief, it's inflationary, just go home tonight and think about it. If you can't work it out, ask your kids. Ask your granddaughter, I think, or grandson, they'll work it out. So a 10-year-old could tell you, that's not right. It's bad. Anyway, so by cutting the cost of energy, and we've got more relief coming out, can I tell you what I would have done? If I was Peter Dutton, what I would announce on Thursday, I would say I'm going to give $1,000 relief to every family in Australia on energy, and I'm going to give $2,000 to $3,000 for every small business. However, when you put your tax return in, depending on your earnings, I'm going to take it back off you. So everyone's going to get it, and when you put your tax return in, you either get a rebate or you keep it. And you work out the line, where the line is, okay? Because certain people don't need it, and they give it back, and a lot of people need it, and they keep it. The thing that would do would substantially drop the cost of living in this country, okay? Now, if anyone knows Peter, that's what I would tell him to do. So for him coming out last week and saying, oh look, it's all bullshit, it's all smoke and mirrors, rubbish. What would it cost Australia? It might cost $6, $7, $8 billion, but I just told you the budget's $750 billion. But it would cut inflation. Sorry. Okay, closing thoughts. I think I used this before, I love it, there's Garth talking to a client. Even he's laughing. Why are you laughing? Okay, so what are we dealing with? I think the biggest problem, and I talk about this often, that when I was managing a lot of money back in the 90s, 80s and 90s, things made sense. There was a connection between bond yields and earnings yields, and the rule of 20, the bond yield plus the PE, the stock market equaled 20, and everything sort of made sense. But the whole thing's gone haywire as we've gone through the GFC out the other side and we've decided to print money. And that printing of money has destabilised the risk-free rate of return. So bonds no longer reflect the extent that bonds are on issue. So we've got $100 trillion of bonds on issue. America has $32 trillion of bonds, and they all trade around 4%. So $32 trillion of owners are happy with a 4% return. Why? You got a guy called Trump in there about the whack tariffs up 25%. We could have inflation in America of 4%, and you're happy with 4%? It's broken. So the interest rate of America, the cost of debt to America does not reflect the risk, not the risk of repayment, but the risk of inflation devaluing that debt. That's the risk which has been completely lost. Anyway, we'll go through these charts and then we can let you go home. Oh, we can have a sandwich on the way up. But what we've had recently is the blue line, which is the dividend yield of the stock market, has now dropped below the bond yield of Australia. And you can see that doesn't happen much. It usually happens in sort of crises like the GFC. But we've now got a return on the share market coming from yield, which is lower than the risk-free rate of return. So that's saying, well, if I'm just thinking about it, then that sort of tilts me more towards yield investments and away from equity investments. Sort of like, why do I want to buy something with a lower dividend yield? Then you go into America, and here we are comparing the earnings yield, so not the dividend yield, the earnings yield, which is the PE inversed, okay? So the earnings yield of America, the stock market, is about 4%. The bond is 4%, okay, we got it? If an earnings yield is 4%, the PE is 25. That's where pretty much, so what we've got now, for the first time since the GFC, and I can go back, I'll probably have to go back to the internet bubble of 2000, we've got the earnings yield going below the bond yield. It's expensive. That's what it's telling me. The American market's expensive. Now, that doesn't mean it's going to fall, doesn't mean anything. It's just an observation. And when you think about investing, what you should do is drift away from expensive and drift towards less expensive. It doesn't mean you get out of international investing. What it does say is your international fund manager should be drifting away from the expensive part of the world to the less expensive opportunities. Yeah? Similarly, in asset classes in Australia, yes, we all want to keep our equities, but we don't have to have as much in equities as we should have in other opportunities. Does that sort of make sense? That's what those charts are telling me. The big problem with Australia is we're dominated in the Australian share market by banks. And I don't know whether you've noticed that bank earnings are about the same as they were 10 years ago. So they haven't actually grown. CBA's done quite well. Well, I have to give CBA has sort of grown. Hasn't grown in the last 12 months. But the whole bank index has not really grown its earnings in 10 years. Hasn't really grown in the last 4 years, but the share prices are up, you know, between 50 and 100%. So I was talking about in the previous charts about comparing earnings yield and dividend yields to the bond yield. When you get compression of earnings yields and dividend yields, you get PE expansion. And what the Australian share market returns have really generated is expansion of PEs. The market's prepared to pay a higher price for the same earnings than it did 3 or 4 years ago. Now, normally the share market's predictive. So the share market is somehow predicting that there's going to be a massive increase in bank earnings. Well, 10 years there hasn't been one. Why are we expecting any now? So that gets back to the weight of money argument. We're putting way too much money in Australia into super. It's defaulting into the stock market. It's defaulting into banks, and bank share prices are going up. I used to dispute this connection, but now it's becoming obvious. So which makes the share market an interesting place when you think about it, and you know, it really does contest value investing. You know, if the weight of money is going to destroy value type investing, then we have to be aware of it. Doesn't mean you get out of the equity market, it just means you think differently and how you invest. That's all that is. Something to talk to us about. Having said that, there is no doubt that the performance of the American stock market has been astronomical. I showed you the productivity of the American worker, but also the profitability of these top 7 stocks. You can't deny it. So yes, they have rocketed, but their earnings have also rocketed as well. There is some cracks appearing. You know, Apple is beginning to struggle to grow, and who sold that recently? But Warren Buffett sold it about 6 or 9 months ago. Yeah, across the market. Nvidia's growth is astronomical, but it's going to slow. Tesla's had a bit of a hiccup, you know. He sort of should be concentrated more on his business than on the White House. But my point is, yes, as a market it looks expensive, but inside that market there is some explanation to the performance of the American stock market. How much of that performance and the potential is already priced in is the question mark. Okay? There's a strong analytical view that the American stock market is still pricey, even though it's pulled back 10% since Trump. So volatility. The other issue about stock markets is you can look at long-term history and what's normal. Okay, it's not abnormal to get strong performance year after year in the American stock market. In fact, negative years are more in the minority. You know, markets rise 75% of times. But what's more interesting about this time, you have to go back, you really are playing with fire when you get 2 years of plus 20%. You know, there is some precedent, you know, so it's not it doesn't mean we have to, but there is when you do get strong compounding growth in stock markets, you do follow with quite strong compounding pullbacks. So something to be aware of in terms, again, of allocating to offshore markets. Yes, we need to stay invested offshore, but maybe the allocation to America should be thought about. How strong the performance is, you can see that the blue line, the S&P 500, the broadest American index, has outperformed in the last 2 years dramatically. And again, not normal, explainable to some extent by profits, but that sort of breakaway is not normal. It feels good when you're getting lifted in a wave, it feels terrible when you come back. So again, there's another warning sign on the stock market that maybe again, and you've seen, interesting, the last month or so, the resounding performance of the German stock market. Now there's been political changes there, but I just wonder whether Trump's tariffs and the response of the European Union may see that part of the world index start performing. And the problem is it's already begun to perform, so you know, you've got to jump onto it. But I do think it does say to my point that we have to be conscious about America's overvaluation, the slowing and the inflation, and maybe the opportunities are better elsewhere in the world.
John, if I can ask a question, on the previous slide you emphasised the effect of the MAG 7, and that S&P 500 chart is a market weight index, isn't it? So
Yeah.
if you had an X MAG 7 in there, would it
Oh, there it is there.
point as strongly as that?
Yeah, you're right. Brilliant question. You get a sandwich later for doing that. Well, there it is. There's your answer to your question. So it's taken out on that one. So if you do want the slides later to be sent to you and so you can look at them in bed and put you to sleep, we're happy to do that for you. It's much better than tablets. Just get my charts. So your point is right. The American outperformance is being substantially driven by the Magnificent Seven. Yeah, so X the Magnificent Seven. I'd still say the blue line would be above these, but which makes diversification. So if you were well diversified, you didn't pick up on it. If you weren't well diversified, you benefited from it. So, yeah. Okay, so we now know the US represents 72% of the market. That's a great opportunity for a international investor to think outside the box. You know, indexing drives you more to the US, common sense drives you away from it. So that says the great battle between common sense and indexing and default investing. And unfortunately, the more money you get to invest, you default. So that goes to, talking about default investing, industry fund allocation. We've talked about this relentlessly, that they're too big for the Australian economy, they're too big for the Australian capital market, they're defaulting money offshore, they're selling the Aussie dollar, and they're putting a lot of money into the US market, capital markets. You in this room, in the main, are self-directed retirees. You might have been part of this in the past and now you're directing your future. You can be a lot more thoughtful in your approach to international investing. Unfortunately, the more money that the industry funds have, they can't be thoughtful. They're stuck. You know, they've got way too much money, and we need to think about that as a country. Is that, you know, and God forbid the Parliament of Australia directs the industry funds how to invest. Okay. Last few charts. So you've done very well. I think that coffee worked fantastically well to keep you with me. So thank you for that. I just put this up because it sort of, again, it jumps off the page. The power of compounding, but compounding works when you buy growth assets. It doesn't really work when you buy passive assets. Now, it's something to think about with your advisor or how you're thinking about asset allocation. Depends on how old you are and your risk profile and your health and all these things. But, you know, if you're looking for, and this young gentleman who left, and this was the most important part, so he didn't get to see it. You know, clearly someone who's young should be more invested in the high growth assets and letting the money compound, okay? Compounding's a great thing, as Buffett will tell you, you know, the great compounder. Okay, stock selection 1, letting good investments run and accepting that equities, even today with the it's funny thing about it, even with the American stock market being overvalued today, Buffett has often said this, even though it's overvalued, and I agree with this, it'll still be the best performing market over the next 10 years looking back, the American equity market. It's just that its return won't be as dynamic as it could have been if we bought it 20% cheaper. So compounding and patience reward you. However, if you're very passive, you get very average returns. Government bonds, Australian government bonds, 1.7% over 10 years. So, you know, Australian corporate bonds, 3.1. Australian cash. Now, what's happening now? Cash is now, as you know, 4%, about to come back to 3.5% probably the next 12 months. Australian corporate bonds, we're probably getting 6 or 7%. That's why that's jumped up from year 5 to year 10. It's all back-ended, okay? The 1 year return 5.4%, okay? So that's coming into play. Yep, that's coming into play. 37% for America. Crikey. Which has dragged up the international index. But longer term, it's running way above its long-term average. And that 10-year average gets the benefit of being slammed during the GFC, obviously, and the recent tremendous performance is really more. That long-term number is usually around 10%. So we're running over 10 years 5% above where it should be, which is also dragged up international. Corporate bonds, I think, is way below its long-term return, which is probably more like 6 to 7%. Gold has come into play, as you can see. And given the uncertainties, and the more Bitcoin stumbles, the better for gold. So there you go, I mentioned Bitcoin. Yes. I always get this question, you didn't mention Bitcoin, John. Yes, I did. You didn't mention India. Yes, I did. Sorry. I've just been doing this too long. When you do it too long, you go a bit nuts. Okay, so pure speculation predictions. I've told you about my predictions for the budget. Tonight, it's going to be interesting to watch what number they land on. The big number, and I'll probably put this out there when I get home and I can write a bit about the budget, I'm really looking for the projected gross growth in the Australian economy. So where's the Australian economy predicted to be? At what point do we become a 3 trillion Aussie dollar economy? Okay, that's just tonight. But more longer term predictions. Look, America is consuming a lot of foreign capital and Australia is providing a lot of it way above our per capita. So as I said earlier, we're about 2% of the world economy, but we're creating about 3% of the world superannuation assets, long-term investment capital. So we're batting way above. We're saving so much money. Why? It's a good feel to have a lot of money, but you've got to have a reason to save it. You've got to invest it, you know? And I just wish that we were investing in Australia. So all these things which say we can't afford, we can afford it. There's nothing we can't afford. On a 10-year view, there's nothing we cannot afford. So don't believe that nonsense. We could all afford to buy a Whyalla. And still have some money left. Okay, so US economy continues to attract capital, but I've got a question mark over this. I don't believe he's going to run aggressively or more. I think he's going to pull back on tariffs. If he doesn't, not only will he cause an issue for his own economy, that he could create a capital strike. And America can't afford a capital strike. They need the world's capital to fund the government. You know, they need that. So just watch this space. The concentration risk into US assets is increasing, and I think that's dangerous, and we should be going the other way. So this is more an issue for our major industry funds, but it's also a case right around the world. There's been too much default investing in America. It's great when it works. It's terrible when it doesn't. And I think the warning signs are there that default investing into America probably should be checked at the moment until further notice. We can turn it on any time we want, but we shouldn't be defaulting there. Government deficits and debt. The way the bond market is behaving, completely oblivious to the economic outlook for America, the government deficit, the budget, the debt, just leads me to the view that the bond market is still succumbing to being rigged. Okay? German bond yields at 2.7. You've heard me say this before. The Greek government, is there any Greeks here today? Just before Greeks can, yeah, George, sorry George. The Greek government can borrow money 1% cheaper than Australia. They're, I don't know what they are, B- and we're AAA. Why can they borrow money cheaper than Australia? Because it's rigged. The trick about it, if you know the market's rigged and you're not rigging your market, who's the stupid one? We have great capacity for Australia to fund our debt and to fund our future growth and not be subservient to foreign markets, is my point there. But you won't hear about that in the budget tonight. Now, the bond market in America, subject to Trump, and I don't think he can bring the deficit down quick enough. I don't think Elon can find $500 billion of cost savings in the budget, but I could be proven wrong. America will still have $1 trillion plus deficit in FY26. Therefore, the bond market will require continual support. We've had the first indication of support from the central bank by reducing quantitative tightening. That's where they've reduced their selling of bonds back to the open market. I think we may see quantitative easing in America come back again. The Federal Reserve, as I said to you earlier, is totally confused. They have no idea what's going to happen. That's pretty scary when the Federal Reserve says that. Inflation has steadied around 2.5%. The cost of living is probably running at 4%, but the inflation rate's 2.5%. Real interest rates, if they go back to about 1%, and this is pre the tariff discussion, but I don't think tariff affects our inflation, then you can see cash rates in Australia going towards 3.5% by the end of this year. So that's okay. That's a tailwind for the stock market. That's the good news there. So that will support the stock market. Doesn't mean it's a great year for the stock market, but it supports it. So 2025 is clearly a year for yield. There's passive yield and there's less passive yield, and what we're investigating at Clime is the move into opportunities in the private debt markets, not so much the private credit markets, but private debt markets. We think there's still a good potential there. I think it's great that ASIC is confusing everyone with their inquiries. It won't be good news for those people who have invested in frozen retail super funds, but the upshot of that is there'll be a bit of panic, and we want to be ready for a bit of panic, because the best time to invest in an asset class is when people are panicking around it. So we're carefully looking at opportunities there, so that's something we think we can make a reasonable return. But we just think balanced investing this year, you're probably looking at a 5 or 6% return from balanced investing. If we can tilt the portfolio more to yield, a little bit more risk, we can probably get to 6 or 8. The equity market, I think, is just a yield market, so that tells you about 3 to 4% return. Property market coming back, so some of those properties we own will probably come back into play after being slammed, but certainly the debt market is something of interest. Alrighty, thanks for putting up with this. That was only 4 hours, so you've done well.